Welcome to the daily update, where I'll go over the action in the market for Tuesday, December 24th, and then we'll see how things look for Thursday, December 26th. As I record this, it's early Christmas morning where I reside, so once again, I just want to extend a Merry Christmas to everybody. And it looks like we're turning back more positive, especially when you measure things on moving averages. And we've been able to get back above the 20 period moving average. We reclaimed the 50 period moving average on Monday. So it looks like things are getting better, but the market can still be vulnerable at this point. We are seeing signs of improvement under the surface. Other things that were strong, they're still staying strong. When you take all of that together, it does look like we're shifting a little bit more positive right now. Before I go on, I did wish everybody a Merry Christmas, but also I want to extend a Happy Hanukkah to everybody. If that's a holiday that you observe, Happy Hanukkah to you. Okay, I do have a thing called the SPX Investing Program. It's going right now. It's still free until the end of 2024, so about another week. It looks like we'll be going with that. And there are additional videos that I post there. There'll be additional things that I run out or roll out at the beginning of 2025 that I'm not having in the program right now. It's more proprietary, but feel free to check that out and see if it's something that would benefit you. There's a link that'll take you to the website or to a video. You also get immediate access to the videos as I prepare them. Also, the daily video, that's what I do, is really focus on the daily videos. But then I do a number of weekly videos, and those are meant to tie into the daily video. Okay, let's go back and talk about what happened. It was a pretty positive day. Volume was really below average, though. We ended up having a higher open, and prices climbed above R1. We got above that 6,000 level again. Prices continued to climb, and then we ended up closing at the intraday high at above R2 at 6,027. Not an awful lot of selling. It was a pretty positive looking chart. We were up 1.1% on well below average volume. When you look at moving averages, we are back to positive in the short, intermediate, and long term. We're in the process of possibly improving under the surface when we look a little bit deeper, and I'll go through those charts. And interest rates came down just a little bit, but they're going up overall. And I have some charts to show you later that I found on Twitter that I'll go through there. And then we have a major holiday right now. We'll see if anything geopolitical happens to kind of throw that into check. But the market has been ignoring the geopolitical events, at least to this point. So some comments. We're back above 6,000 with the S&P. The VIX continues to drop. Now we're under 15, and that's what happens when we're going down with the VIX. That means we're going up with stocks. We still have a confirmed Hindenburg omen, but no additional spikes. I'll show that chart near the end of the video. On a short-term basis, we still have some extreme negative readings. The CCI based on 20 periods and the 20-period simple moving average study. Intermediate term still have some PMO studies that are extreme negative and the 50 period simple moving average study. And the scenario hasn't changed, at least since the previous video, where last week the Fed did come in and cut rates another 25 basis points, but has now signaled that they're probably going to pause the rate cuts, and they've also increased their inflation outlook. That's why the market really took a dive last Wednesday. The dollar was up and interest rates were down just barely. We were at 4.6%, and that's pretty stinking high for the 10-year yield. And we dropped to 4.59%, still really high, just one tick lower there. Sentiment is still negative, but the context is that we're improving. So we had been at 30, we're coming up to 34. So even though it's giving us a low reading, the context is that it's going up, and we can treat that as more positive. We're still negative with our trend. The red line is above the green line, but the red line's coming down and the green line's going up. We're also seeing the ADX dropping below its moving average, suggesting a weakening trend. but we're still above 20. So we are still in a trending environment. And with the up day, our bias is positive, and I'm keeping our momentum at mixed to positive. You could might be able to lean a little bit more to the positive side, but after we go through the charts, see if you might still think that we're looking a little more mixed. Okay, we didn't have any economic reports, so there's no charts to show you there. Isabel net blog charts here. We're really coming down with our overbought, oversold indicator. We had been up into this 90 range and we're coming back down. We're at 68, between 68 and 69 now. Now, this could suggest there's more room to fall, but also that big decline last week just it caught a lot of folks off guard, and we went from positive to pretty negative in a hurry there. And so people were feeling very optimistic, suddenly changed to being more pessimistic. And then the next 7 days historically are very bullish. This is going back to 1950. And this looks at what returns are like during the Santa Claus rally. Now, this can kind of sneak up on us a little bit because we typically will see below average volume. And so we just kind of drift a little bit here, drift a little bit there. But then if somebody comes in and does something major, that can really have an impact on the market. And so just showing over the last number of years, going back to 1950, when we've had positive Santa Claus rallies here. And then more money than fools or more fools than money. This is just looking at the world index capitalization relative to the M2 money supply. And of course, the US is way in the lead. And that just means, okay, there's more capitalization out there than there is money right now. Does that mean people are foolish or are people being wise about this? And then compared to the other countries here in the chart. 10-year treasury yields. Now, we'll have to see. Goldman Sachs thinks we're going to go down and get to about 4.35% with the 10-year yield. Now we're at 4.59% currently, where the markets are thinking that the 10-year yield is actually going to continue to go up. Also, is Mag 7 a mania, the Magnificent Seven? This is just looking at the valuations here. And these are other times throughout history, the Nifty 50 back in the 60s and late 60s, early 70s, gold. I remember when that happened, when gold was going up over $200 an ounce, $300 an ounce. Woohoo! And then the Nikkei, that was really seeing, that's the Japanese index. It was really going up there for a while. The Nasdaq 100, this is the dot-com boom. And then oil was really spiking up there for a while. And now we have the Magnificent Seven. And so, okay, are we getting kind of crazy here? Or is this justified? Now, one thing that I will say that separates what was happening in the late 90s into 2000 with the NASDAQ 100 here, there weren't necessarily earnings behind the companies at that time. And we're seeing the earnings there now. So that is one major difference between the two. I know everybody wants to take right now and compare it to the dot-com boom and then ultimate bust, and something like that may develop. But the context is different. These were fantasy companies back in the dot-com era that really didn't have a building, didn't have any earnings. I mean, they show videos of these people popping bottles of champagne and they've got a bunch of boxes around them because they haven't even moved into their building yet. And so they have this IPO, initial public offering, and they're instant millionaires, but they haven't done a day's work yet. Or at least the companies that are in the Magnificent Seven, they've been around a while. They stood the test of the time. They've had some really good times and they've gone through some difficult times as well. So I see that in a bit of a different context. Okay, then we expect rate cuts will continue in 2025 in all major economies. Well, good for you, Goldman Sachs. They just think that rate cuts are still going to continue here worldwide. And then equities as a percent of financial assets, still the highest number over here are U.S. households. Now, this may not be people actually managing their own portfolio, but we have pension plans, we have 401ks, there are retirement plans, and what have you. And most of those programs are involved in stocks. And so that's why we get the highest reading here. Then this might be a little crazy to read through. It says strategists often miss the mark when forecasting. You think? I mean, these are people that are professionals and they're supposed to know what they're talking about. That's why I don't forecast, okay? Because these people are wrong. You might be better off just taking a dart and throwing it and saying, okay, I think that's what's going to happen. And if you stop this and look this over for a little while, it just talks about what the forecasts were and then what ended up actually happening at that time. And so they, people love forecasts. It's like the weather. They think they can look off into the future and know what's going to happen. And of course, everybody says their forecast in such a way so that they're never wrong. Oh, just like I said, just like I pointed out, and this is what I anticipated. Okay, I watched a video over the weekend talking about forecasts. I think it's interesting. I kind of pay attention to that stuff, but I don't use it. I look at a day in and day out evaluation of where we're at right now, and then what's the probability of going up from here or going down or going sideways from here. All right, market returns, actual distribution are far different from the forecast. Well, duh, yes. See, now we're getting into the end of the year, and you had forecasts a year ago that were way wrong and either positive or negative. Of course, you've got the perma bulls that think we're just going to constantly go up. And if you were to lean to one side, that would be it because 70% of the time the market goes up. Well, then you've got the perma bears. The doom and gloom is just around the corner. No matter how much positive information you throw at them, it's still going to fall apart very soon. And I follow a couple of these folks, and it's more entertainment than anything because some folks have been following 20 years or so, and they're just always wrong. But they're totally convinced that they're right. And you get people that watch this stuff and they're going, "Oh my gosh, things are going to fall apart. This person must really know what they're talking about." And then they change their investments around and then they might miss out on an 8, 10, 15, 20% gain because these folks are always preaching that the end of the world is near. Well, the other side of that, I mean, there's reality. The market goes up, the market goes down, but it goes up a lot more than it goes down. All right, here, Magnificent Seven against smaller tech. Now, there's two ways to look at this chart. First of all, you can see how the Magnificent Seven are really doing well here, and how the smaller tech companies, they have really been underperforming. That's the negative side. Well, it could be positive in the, okay, I'm buying me more Nvidia, I'm getting more Google, I'm getting more Apple. Okay, if that's your thing. But the negative side is that, okay, these smaller companies have not performed as well because even these Magnificent Seven, they started out as small companies. They had to grow into big companies. There's another way to look at this chart where you could turn it around and go, I see some opportunities here. Look at how small cap tech is underperformed. Maybe I can find some really good investments in that area. So again, there's a positive side and a negative side with this chart. I did spend a little bit of time on Twitter. You're bored. A lot of the news podcasts that I listen to, they're off for Christmas. So it's like, okay, I'll just hang out on Twitter right now because there's really not much else to do as far as the day in and day out gathering of information. But I thought this was kind of interesting. The percentage of Congress that's over the age of 70, I mean, you should have gone long here because you are just seeing a parabolic rise at this point. And it's just showing that, yeah, the folks in there are pretty old, you know, all right. And then market valuations. Now, this is looking at the forward PE ratio of the tech sector. And we're getting to kind of a high reading here, but can earnings justify that? These are companies like Microsoft, Google, Apple, Nvidia, and people want to really buy those companies and they don't mind if they're already expensive. They just want them to go up and become even more expensive and they can make a profit. And then this is kind of interesting, put out by Bravos Research. Whether you include or don't include inflation in the overall equation, going back, what is this, to a long time ago, 1918 or so. If you don't take inflation into account, we had an 80,000% return on the S&P 500. If you do take inflation into account, we had a 5,000% return. So I mean, 5,000 is still really stinking good, even with the declines, even with the crashes along the way. We've still been up over 5,000%. But that just shows you the bite that inflation can put into things that I'm sure you're already feeling. This is another thing interesting. We see a period of time when most of the gains or even losses happen during the overnight session. That's why I go through. I'm always watching the futures. I have a chart of an intraday chart of the SPY that it's extended hours. It continues after the market closes and then shows us what's going to happen before. Because a lot of times that's where the real performance can come from. Where we have the red line here, this is the overnight, and that's when we gap higher and end up just continuing to go up after that, where the intraday. Now, lately, we've seen that a little bit opposite. We've seen the futures be kind of muted, and most of the price action has come during the intraday session. But that'll go back and forth. All right. And I don't know, I have yet to see any of these charts actually be correct. This is just showing the equity positioning on the top. And I don't know how they calculate this, but this just says that the CTA, the commodity trading advisors, they plan on selling no matter what happens over the next week and into the next month. Okay. We've looked at this chart before and it was completely wrong. They like every scenario said we're going to sell, and we ended up hitting all-time highs after that. But one of these days, maybe this chart will actually be correct, but it hasn't been all that useful to this point. This is put out by Chris Schiavocco at Schiavocco Capital. This is another positive thing that we've been seeing when you do a ratio of the tech sector to the equal weight version of the S&P. And we had been going into some previous resistance here, and we're really starting to break out. And this is more positive for the market. When we see the tech sector really leading, that tends to be a very good thing. 10-year Treasury yield, where not too long ago we were at 3.6%. And then the Fed comes in and cuts rates, and the market knows they're going to cut rates. And we've just been shooting up. We're closer to the 4.6 level right now. But my goodness, this is a really big upward move. At some point, are we going to top out with yields, have them come down? Because this is a lot of the reason why, I mean, the stocks have been doing okay, but they're not really breaking out to the upside. And a lot of that pressure has to do with rising interest rates. If this can come back down, that would really, really help stocks to go up. All right, here's our intraday chart. We had a higher open and we quickly got above R1, then we leveled off here and we worked our way up to R2 and closed at the high. I mean, you can't get more positive than that, even though we closed 3 hours early. This is the intraday chart that I was talking about here, where we have the light blue area. This is the initial overnight session, and then I'm sorry, the pink area is the initial overnight session, and then the blue area, that's the pre-market session. And a lot of times that'll produce either a gap up or a gap down. Well, we were pretty much flat here, and then we saw a lot of the strength happening in the daytime. And things are very quiet right now as everything shuts down for Christmas here. But this is a pretty positive looking chart right now. And we're also looking positive here. And we have been looking positive. If you go back to the latter part of November, where the blue line was really starting to come up, the red line was starting to come down, and we still see the blue line above the red line. That means on an intraday basis, growth is continuing to outperform value, and that's more positive for the market. Also, the S&P growth to value ratio, back to the latter part of November. This continues to look pretty positive for the time being. End of day, we were up 1.32% with growth. We were up 0.82% with value for the large caps, up a little bit more with the mid caps, and a little bit more here with the small caps. So we look at our ratios, small cap growth to value. Even though the index, and we bounced up a little bit here on Tuesday, but we've really been coming down here while this ratio has been going up, and that could be positive for the small caps. Also coming down with the mid caps, bouncing a bit on Tuesday, but the growth to value ratio still looking quite healthy. Also, still looking really good here with S&P growth to value. So in a more positive environment, we will typically see growth outperforming value. We're not really seeing all that much of it at the index level, but we are seeing it under the surface. This is really looking quite positive. A growth versus value ETF, we're breaking out to an all-time high here with this particular ratio. Discretionary to staples, another ratio that when discretionary is outperforming like it is here, that tends to be more positive for the market. Large cap growth, not back to an all-time high yet, but it was up 1.3%. And this is the ADX, the condition of our trend. We're starting to go down and dropping below the moving average. That suggests a weakening trend. We're still above this blue line, which is a static number of 20. So we are in a trending environment, but it's a weakening trend. And the red line is on top, so we default to positive. But the red line's coming down as the green line's going up. We get another day or two of positive price action. This could actually switch back over and turn to positive. And we're seeing pretty much that same thing here with the short-term chart, going down below the moving average, red line coming down, green line going up, but we're still negative until we actually see a cross. Volume really dropping off, and not a real surprise there. Sentiment, we're still getting a fairly high reading here with the Ulcer Index. This tries to measure the fear, mainly as they apply to mutual funds. The VIX continues to drop. We're dropping below the moving averages, both with the line chart and the bar chart. And the VIX of the VIX is also coming down below its moving averages. And that's what we typically see when the market's going up. We're still seeing an upward momentum here with the VIX, but the MACD is really rolling over. Another day or two, and this could actually cross over, and the momentum for the VIX could switch to negative. And this is typically what we see seasonally. We're coming up over here to the lower right-hand side here, where we don't go straight down or straight up, but the VIX popping up last week, that freaked out a lot of people, but that now that it's coming back down, that's giving people a little bit more confidence too. And we're still getting a really high reading with the skew index. Okay. It looked like when we were going up, this was coming down. Well, we went up in Tuesday's session and the skew index went up. So there's still folks anticipating a big move. And we're not really sure if that's an upward or downward move here. We did drop with this fair gauge. We're also declining with the other fair gauge. So now we're seeing more confirmation of fear coming out of the market. And this ratio continues to go up. When we look at risk on versus risk off, when the market's more positive, this ratio goes up. And we ticked up a little bit. This could be some pre-Christmas hedging going on here with the daily chart. We're ticking back up a very tiny little bit here with the 5-day chart. And here's a long-term look at the 5-day chart and ticking up just slightly with the 10-day chart. Volatility risk premium continues to drop, and we're coming to the lower end of the lower end of the band here. If we continue to fall, that just means there's less fear in the market and it's coming out of the market. So we're seeing an improvement here. You can see these nice little green bars up here based on price. We really dropped off based on volume, but we are seeing an improvement with the advanced decline line for price and volume. Not back to the previous highs, but we had been just seeing this going down, 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 even as we were going sideways with the S&P. The fact that this is going back up shows that things are improving. And not really improving much here yet. We saw a little bit more of an expansion of the new highs and a contraction of the new lows, but we're still going down with the 5-day and the 10-day. We need to see the S&P continue to go up and then these green bars grow as we're going up for the internals to turn back more positive. And we're looking a little more positive here. We're just barely trying to come above the moving average with accumulation distribution. This is a smart money indicator showing an improvement here with our advanced decline ratio, both the blue line and the red line. They're still negative, but the context is that they're bouncing up. And so we're not quite positive with the advanced decline line based on 19 periods for price, but we have crossed the back above zero and are looking positive based on volume. Showing an improvement here, flattening out with the chicken money flow, another smart money indicator. The histogram is starting to come back up, but we haven't turned full-blown positive. That'll be when we go green, and we'll be even more positive if the red line turns and goes up. This is more encouraging, though, and this was actually positive after Monday. We're going up with the Chaikin oscillator, another smart money indicator. There are three of them that I use: accumulation distribution, the Chaikin money flow, and this one, the Chaikin oscillator. And we're going up above the moving average, and that is looking just full out positive right now. It'll be even more positive if we get back above zero. And seeing things negative here with the vortex, but the red line's coming down and the green line's going up. Seeing a bit of a tick up here with the cumulative advanced decline line for the S&P based on price, a little bigger advance up here based on volume. And seeing an improvement here as the S&P's been going up, we're seeing the NYSE advanced decline line start to go back up too. This is the S&P index versus the broader market. And we kind of look at those, and it's not a true comparison, but sometimes we can get some clues. For example, we were going sideways with the S&P as the advanced decline line for the NYC was going down. And then we ended up falling down after that, just like London Bridge. Okay, we're still not really showing much of an improvement here. And this is more intermediate to somewhat long term. A 10-day average of the highs and lows for the S&P, we're still continuing to be below 50 and declining. We're seeing an improvement here with the NYSE cumulative advanced decline line coming back above the moving average, starting to turn up, but still below the moving average with the regular NYSE advanced decline line. Also, this other NYSE advanced decline line improving, but still below the moving average. And we're going back up and bouncing here with the the common stock advanced decline line based on price and volume. And seeing an improvement here with the advanced decline line studies, going up with all the indexes, but still below their moving averages. Seeing a bit of an improvement here with the stocks above their 20-period moving averages inside of the S&P. Until we get back above 20 here, this is still extreme negative. And this is the study that we've been watching. Now that we had a very low reading, we need fairly quickly for this reading to get up above 70. And that would be more short-term positive, showing good upward thrust there. Also bouncing back up with our 50-period moving average study, going back up with the 100-period moving average study, and going up with the 200. So we're seeing some gradual improvements here. And we look at the large caps versus small caps, where this ratio continues to go up, meaning that the large caps are outperforming. Here's a chart. Maybe we kind of overdid it, you think? On a 1-day basis, the advanced decline line percent is giving us an extreme reading, and the advanced decline ratio also giving us an extreme reading. Where just last week, we were getting extreme negative readings with these charts. And this is hard to see because we're getting ready for the January pivot points to come in here. But we're back above the 50-day moving average. And then on the bottom, volume as well below average. No longer extreme negative and improving with the 20 period going back up with the 50 and the 200 period moving average study. Crossing above the midpoint with the Stochc RSI, a short-term indicator here that's improving. Going back up with the Williams percent R above the midpoint there. And coming up to the midpoint with the CCI 14 and the CCI 20. And then we're seeing an improvement here with our short-term stochastics. We'd gone extreme negative. Now we're starting to cross above the midpoint. Intermediate term starting to cross above the midpoint. We're still declining with our longer-term stochastic. The force index is above its midpoint and going up. That's switching back to positive. This is the condition of the short-term trend as measured by 20 periods. We're coming back above the blue line and the green line here, and they're slowly starting to turn back up. If we can keep going up, these lines will turn back up, and that naturally will be more positive. And we were able to recapture the 20-period simple and exponential moving averages. This is why we're switching back to positive in the short term. And coming up to the top end of the rainbow after we had sliced down below the rainbow fairly quickly there, we've now been able to bounce back up. We're coming above the midpoint here with our standard deviations chart. So that's going from negative, switching back over to positive. And turning back up, but still negative with the balance of power. The go, no go is looking pretty positive here with the darker blue bar after it was saying no go, no go. Now it's saying go, go, go. All right, highest high value starting to cross back above the midpoint, seeing an improvement here. The TTM squeeze is picking up this nice little move up. We're actually going back up a little bit, and we're turning to the lighter shade of red. So that's showing an improvement. Standard deviation, it's the last 10 trading days, so it's going to get that big downward move in its calculation. If we even continue to go up, and once this last Wednesday's move gets taken out of how it's calculated, the standard deviation is really likely to drop. Improving, but still negative with the ease of movement. And you can see the 1-day measure here is pretty extreme. The Arun, it's like I'm already on vacation here for Christmas. Don't bother me. We're turning back positive with the McClellan oscillator for the S&P. We're crossing back above zero. That's a good sign. And so if this can continue to go up, naturally that's more positive. So we're just starting to turn back up here based on price, and we've already started to turn back up based on volume. So this is under the surface here. We're seeing some improvements for the S&P. We're still negative, even though we're improving with the NYSE McClellan oscillator. So we're still going down with the summation index based on price and volume. This is another thing that's showing an improvement and almost ready to turn positive based on volume. Not quite there yet. And also improving based on price is the Swenlin trading oscillator. Momentum is still negative though. We're going down with the PMO. We're trying to turn back up with the when we break it out based on price and volume, but still a ways to go to get back above their moving averages. We're no longer extreme with the PMOs that are rising. We're bouncing up out of that, but the buy signals are still extreme negative, and we're still flat to slightly declining with the PMOs above zero. So the momentum is still negative. The slope oscillator continues to decline. The MACD trying to turn up, but a ways to go to get back above its moving average. So across the board, short, intermediate, and long term, we're still negative on a momentum basis. And the Copic curve is still negative. But the Sean trend meter is looking more positive and going back up. And we're bouncing back up, but still below 50 with the ultimate oscillator. The money flow ticked down a little bit. Figure that one out. But we're still above 50. On balance volume, still going up above an advancing moving average, crossing back above 50 with the RSI 14 and the RSI 9. So this is showing an improvement here as well. And this is kind of a big deal. The parabolic SAR, we have a dot underneath now. And I forgot to put that in the earlier notes. But this is, in my opinion, a pretty positive development. We'll just see if we can get more follow through there. And we've gone from neutral to positive with the Elder's impulse system for the S&P. We're still below the red line and the blue line here with our intermediate term trend, but we are improving. But we're above the simple and exponential moving averages here. That's what turned us back to positive. So we're back above the 20, 50s, and the 100 and 200s continue to go up. So we're looking more positive technically here, but not really much of an improvement here with the bullish percent index. We ticked up a little bit, but we haven't come back up to the moving average at least yet, and we're below 50. And not much of an improvement here with the NYSE bullish percent index, still below 50. So that's negative. A little bit of a tick up, but below 50 with the NASDAQ 100 bullish percent index. And here's the short term. Now we could call this possible resistance now. We came down below the rainbow. This is a 20 period simple moving average of the open, high, low, close. And we're wondering, are one of these lines going to provide overhead resistance here? Or are we going to be able to bust on through to the other side and pull a Jim Morrison here? We're still coming back up to this trend line here, which may have produced some short-term problems there because we kind of hit this and then came back down. Are we going to be able to bounce above this and actually show more strength in the longer term? We're looking more positive with the Heikin Ashi with the open candle. We're negative but pointing up with the Kegi chart. And we're positive again here with the Renko chart, or we're still negative with the three-line break. So these charts are kind of like, I'm not so sure if we're going up or down right now. We did see some new X's drawn in with the point and figure chart. We had some O's drawn in last week and some X's coming back in. We're kind of coming back to where we were before, so there's no signal that's being generated right now. Long term, seeing a bounce up with the 150 and 200 period moving averages. And that's longer term positive. This is what we're watching now. The ZWAG NYSE breadth thrust. This includes Monday's data. And so we're back above zero point 0.4. Within 10 trading days, we need to get up to this red line. That would be a ZWAG NYSE breadth thrust signal, and that tends to be very positive. If you look at the times they were triggered and what the S&P did after that. And this is interesting too. We had fallen down to 8 with the Zahorchak, an all-American name there. We came back up to 10. That's a full-on buy signal again. And we're still negative with the mid caps and small caps in the short term. All the other indexes are positive. We're negative across the board with bonds based on price. We've switched back to positive with commodities in the short term. And all the sectors ended up being up. What do you know? Healthcare ended up being up the least, where we had discretionary being up the most, and we like that. Communication was up too. That's another growth area. And tech was up over 1%. These are the three big ones that when they do well, that's when the S&P does much better. And nothing but green here. You got like St. Patrick's Day going on, not a real Christmas thing going on here. With the NASDAQ going above 19.8, 19.9, back above 20,000. Yahoo. The dollar is going up, setting a 2-year high. Communication had a BPI cross above 70. That's positive. That's growth. And the Dow was able, at least for a while there, to get above 43,000. And they finally updated this. I don't know if I would really trust the date here because we went negative a few days ago with the PMO. But according to the decision point scorecard, we're negative in the short term with their trend model, and we're negative in the intermediate term with the PMO. But we had already seen that for a few days. We are seeing an improvement here. Both the S&P weighted and equal weighted version are bouncing back up. And we're still going up though with this ratio. That means the weighted version of the S&P is still outperforming the equal weighted version. We're coming up with the Dow. We were up 0.91%, but still below its 50-day moving average. And we're still neutral with the Elder's Impulse system for the diamonds. And hard to see because we got the new pivot points ready to come in here, but we're going back up with the NASDAQ, also going back up above this pivot point here with the NASDAQ 100. And we continue to be positive. We were up 1.36% with the triple Qs, but the momentum, although it's improving, is still negative for the NASDAQ 100. Small caps, which had just fallen off a cliff, we don't know. Is this a dead cat bounce or a real bounce that could actually get some legs here? And we're still neutral with the Elder's Impulse system for the small caps. We look at the Russell 2000 small caps bouncing up after getting an extreme negative RSI reading, still below the 50-day moving average. The momentum is still negative here. Mid caps kind of seeing a similar thing. Bounced up 0.75%, but still below their 50-day moving average. Still neutral with the Elder's Impulse system. And then looking at the bank ETF, this is bouncing back up a little bit. I was concerned because we're dropping below the 50-day moving average, even though the long-term trend is still positive. And we're starting to climb back above the 50-day moving average with the financial sector. That's good for the market too. The Wilshire bouncing up after getting back above its 50-day moving average. Not at an all-time high, but it was up over 1%. That's a broad market measure. Also going up above the 50-day moving average with the total U.S. stock ETF. The FANG index was up 1.45%, not at an all-time high, but not very far from it either. And we're starting to come above this shorter-term trend line again. Can we get above that and stay above it? Apple was up 1.15%, Amazon up 1.77%, Google up 0.76%, Microsoft up 0.94%, Meta up 1.32%, Nvidia up 0.39%, and just a little bit above its 50-day moving average. Tesla was up over 7.33% here. Yeah, I had a pretty good day there. I guess they're buying a lot of electric vehicles for Christmas. Or is Santa going to start using an electric sleigh? I don't know. And Netflix breaking out and not quite back to an all-time high, but looking pretty good. They must have a pretty good store of Christmas movies. I watched a few over the last few days and seeing a little bit of a drop off here with US to world stocks in the short term, but still improving in the longer term. This is another area we're really watching. This is still negative, but it has the potential to turn positive. We're coming above the 50-day moving average with the SOX index. This is the semiconductors. If we keep going up, we're going to be watching the 200-day moving average. This is still a downtrend when you look at this chart. And then we look at a ratio between the semiconductors and the Dow, starting to come back up. If this ratio goes up, that would be more positive for the semiconductors, which means more positive for tech. And kind of just bouncing around here, but we were virtually unchanged with this ratio. But we want to see the semis outperform tech here. Now, but it's more positive when you look at the SMH ETF, the semiconductor ETF here. We're starting to climb above the 50-day moving average, and we're starting to come up into the higher end of the rainbow, coming out of that a little bit. But we've been here before. Are we going to be able to break on through to the other side, or are we just going to fall back and just chop sideways the way we've been doing? The dollar continues to go up. We're into the 108 range now. Really good if you want to do some traveling. And we came down a little bit here with the 10-year yield. We were up with a little bit with the 10-year based on price. I wanted to look these over because we're seeing some signs of improvement here. With interest rates going up, we do some stock to bond ratios and we look at the 3 to 7 year bond and then we compare it to the S&P breaking out here. And this just means that the market is still anticipating that we will not go into a recession. And that's what a soft landing is. And we look at the broad market with 3 to 7 year bonds, not quite back to the previous high, but still showing a lot of improvement. And the Qs to 3 to 7 year bonds, not back to the previous high, but really looking a lot better. The tech sector improving compared to 3 to 7 year bonds. And I'll go over these over the weekend. I just thought I'd do a little bit of it now, too. This is an area of concern, though. Home construction to 3 to 7 year bonds, falling below the 250-day moving average, bouncing up a little bit here, but we need to really see this kick back into gear to turn more positive. Still looking good here with the growth to value ratios for the Qs to S&P, discretionary to S&P, large cap growth versus large cap value. The large caps, mid caps, bouncing up a little bit, but a little more weakness here with small cap growth to value. And still continuing to decline here with the staples to S&P ratio. That's positive for the S&P since staples are more defensive. All right, what's our outlook for Thursday? And then the definition of the Santa Claus rally is that it's the last 5 trading days of the year and the first 2 trading days of the new year. So it's December 24th through January 3rd because we're closed on January 1st. The technicals, I didn't really do anything at this point. We are switching more positive. We are seeing some signs of improvement. And I just forgot to fill that out. Okay. And we're going to get initial jobless claims, continuing claims in Thursday's session. All the geopolitical things, including this man from the North Pole that visits everybody and comes down their chimney. All right. And then on Friday, we're going to get the advanced international trade in goods, wholesale, and retail inventories. And the biggest one's going to be jobless claims in Thursday's session. Seasonality, we're positive for December 26th, at least over the last 21 years with the Dow, S&P, and NASDAQ. And here's looking here for the 26th and then going out into the end of the month with the small caps having good seasonality potential. We'll have to see if that actually ends up happening. Thursday in 2023, it was a positive day, but not the strongest day, where it's been the second most strongest day in 2024. This is the positive seasonality that we think we might be starting to see. And then this compares from election day going out a year from there. This is how the market had been performing when this chart was prepared. And then this is compared to what happened 1 year out. And this goes back since 1960. And we're still in that positive time. From now until the end of December, according to Tom Bowley's research, we are up. And we should be seeing some positive seasonality now with the small caps. We'll see if that ends up happening. So we're seeing an improvement here with our smart money indicators, and you could say we're a little above the moving average with accumulation distribution. We're looking more positive with the Chaikin oscillator. The Chaikin money flow, improving, but not turning positive yet. The advanced decline lines are still negative, but improving. They're still underneath their moving averages. We're going down with the 5 and 10-day equity put call ratio charts. And we're still negative with the NYSE McClellan oscillator and summation index, but they are improving, both of those charts. We're still negative as far as momentum for the S&P. We're negative with the bullish percent indexes for the S&P, NYSE, and NASDAQ 100. We still have that confirmed Hindenburg-Ullman, the vortex. It's improving, but it's still negative. And the Swenlin trading oscillator is also showing, it's 3 days now, it's been going up, and that's encouraging there. We're still looking negative with our 20, 50, and 100 period moving average studies. Ease of movement is still negative. The ultimate oscillator is still negative. The NASDAQ 100 momentum is negative but improving. And the positive signs, we're still, and we've been seeing this since the end of November. Growth and value, we're hanging in there pretty well. Discretionary to staples, that really started to develop last August. And that's one of the underlying strengths that we see in the market right now. And the S&P McClellan oscillator, as well as summation index, has now turned back to positive. Parabolic SAR has turned positive. The money flow is positive, and those stocks above their 200-day moving averages. inside the S&P. That's positive. And the financial sector is positive and looking a little better these days. Then we have the updated chart here. No additional spike, but we still have a confirmation spike. We'll be seeing if something else develops with that. So our conclusion, we are positive and improving. We are in a period of positive seasonality with the large caps and growth leading. But at the same time, we're looking a little bit vulnerable because of the lack of volume, because some of our charts are still negative. They are improving, but they haven't turned to positive yet. In the short term, we're positive and improving as we are in the intermediate term, and we continue to be positive in the long term. Thank you. Have a really good day, and I will talk to you in the next video.